Welcome to Two Quants and a Financial Planner, where we bridge the worlds of investing and financial planning to help investors achieve their long-term goals. Join Matt Ziegler, Jack Forehand, and me, Justin Carbonell, as we cover a wide range of investing and planning topics that impact all of us and discuss how we can apply them in the real world to achieve the best outcomes in our financial lives.
Justin Carbonell and Jack Forehand are principals at Validia Capital Management. Matt Ziegler is managing director at Sunpoint Investments. The opinions expressed in this podcast do not necessarily reflect the opinions of Validia Capital or Sunpoint Investments. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validia Capital or Sunpoint Investments.
All right, guys. Today we are going to work off of a suggestion that someone posted on one of our YouTube videos from last week, actually, when we were talking about Cathie Wood and sort of the rise and fall and rise again of ARK and the ETF. We had mentioned that we launched right around the same time she did. We launched our own ETF. It was called the Validia Market Legends ETF. So this is late 2014. I have my year right, Jack?
I think it was like November.
Yeah. So, and there seemed to be some interest in maybe hearing the story behind that, our experience of launching the ETF, what we learned along the way, what went right, what went wrong, and ultimately, what we decided to do from a standpoint of actually shutting down the ETF. And we'll sort of talk about what went into that decision and the timing of that and things like that. But yeah, so we just kind of thought, and Matt is here to sort of add some thought and color too. I know he uses ETFs a lot in his practice. And one of the things that, is always happening and happening more and more is there's more new ETFs coming to market. A lot of them are from obviously the major investment houses, but there's certainly a lot of smaller startup ETFs as well. And that's sort of where we were operating for basically 5 years. We've actually had many of the guys that have sort of smaller ETFs that might have partnerships with Wes, or maybe they've decided to do it themselves on the podcast. People like Toby, Kai, Ryan Kruger, a bunch of other, smaller providers. And so we can kind of identify with sort of the challenges that they may face when trying to grow an ETF. But Jack, let's just kind of start with the idea that we had, what we were seeing in the market at the time and why we decided to, launch our own ETF.
Yeah, I'm interested in your take on this too, because we didn't talk about it in advance, but like for me, there were a couple things. One is obviously, as I learned about the tax efficiency of ETFs, I was like, this makes a lot of sense for our strategy. I mean, we don't run crazy high turnover strategies, but strategies that have any kind of turnover, the tax efficiency of ETFs can be a big deal, can really help improvement. And the other thing is, at the time, like people we knew at least reasonably well and know a lot better now, Meb Faber, Wes Gray, they had all just launched ETFs and they were having like huge success with them. I think Wes launched, the same year as us earlier. I think Meb launched the year before. I think he launched in 2013, but they were having a lot of success. And so it was a growing industry. It wasn't as mature as it is now. So I think we saw some opportunity, for white space, if we could come out of the gate and we could launch a sensible strategy that it could raise some assets. So I think it was that combination for me of the tax efficiency and also looking at what was going on with ETFs and saying like, this is a really good opportunity.
Just because I'm curious, to the degree you can't answer this, like the asset base to like launch it, I know we're going to get into mechanics, but like with tax efficiency, was there already an existing base where you were like, if we just had this wrapper in place? I've heard Wes talk about this too. Like, did you have people who you were like, this would be better if we just put this wrapper around it, so that's why we should start?
Yeah, no, definitely. We had some of our existing clients. Like our initial plan was, because one of the things, and we'll probably talk about this as we talk about the whole thing, is like you launch this ETF, you need assets. You need to like show some sort of growth. You need like trading to exist. You need these things to happen. Like if your ETF just launches, we'll get into the seed capital and stuff. But yeah, we had some of our own money that we were going to put in there from our own clients and some of our own personal money as well. And then we also, we're hoping to attract some outside assets. So we were going to use like our existing assets, which we could run, more tax efficiently in the ETF wrapper as a starting point. And then we were going to hope to grow from there. That was the idea.
I asked that just because I think it's interesting as like an advisor, an allocator, we think about what are the best ways to like express certain views. And I remember this from 10 plus years ago. Now, a lot of people talking about it with direct indexing, listen to our episode on that, but like the smartest wrappers to do the things that accomplish what you want to do, because there's options. Amazing that you guys seized one of them. Well, we'll get the whole story.
Yeah. The other, just two other points on the why we did it. I think, we, like Meb and Wes to some extent, there was a strong content underpinning or strategy, and we, had lists that we had built over the years. So we felt like we had some built-in internal like marketing muscle outside of trying to do like advertising or, having wholesalers out there trying to sell the ETFs. So, because our research product is more of a retail driven product. And so over time we've built, lists of people that have either used the research or read the blog. And so we had kind of that going for us. And then, at the time, one of our largest clients was super, super tax sensitive. And he kind of had this like very, very long-term view, like generational, decade type of view on investing. And when you have someone that's worth that much money, saving on the taxes was huge. And so we had sort of an anchor high net worth, investor in there as well. And in terms of the process and the cost, Jack, I mean, you had a lot more, I guess involvement but you were the guy running the spreadsheets, looking at the cost, looking at, what we actually had to do to get it up and running. So maybe walk through that a little bit. It's changed a lot over the years. Obviously the costs have come down. You have white labeling, places like, Wes's firm and others that were actually even out there when we existed. But there has been, compression on those costs. And I think, actually more and more people seem to be using, at least startup ETFs seem to be partnering with people like Wes versus trying to do most of it themselves, which is sort of the path that we took.
Yeah, I would say, first of all, anybody who's listening to me on the podcast and the nerdy quant stuff I do would probably not be shocked that I was the guy running the spreadsheet. But I was the guy running the spreadsheet. So at the time, it was a little bit of a different landscape at the time. So at the time, you kind of had two options. You could either launch the ETF. I mean, you need partners to launch the ETF. You need a custodian. You need people to trade. You're not going to do that yourself. But you could either do it on your own other than that stuff, or you could go with like a third-party firm that would do basically mostly everything for you. And you would just kind of send the trades and you'd be in charge of gathering the assets. We decided, as we've always done, like I think our careers, we decided we wanted to do it on our own. We thought we could do everything ourselves. So we went that direction and we saved some money doing that. So back in the day, there was this thing called exemptive relief that existed. And I think it still exists for certain type of ETFs, but the idea was to have the ability to launch an ETF, you needed relief from like this SEC rule. And so the first step in launching an ETF was you had to apply for this exemptive relief before you could even have the ability to launch an ETF. And then after that, you had another waiting period to actually go through all the different forms and everything that are involved in launching the ETF. So it was a longer launch cycle back then. So I think it was like 6 to 9 months from when we signed the papers to do it to when the ETF actually came out. And also that exemptive relief made it more costly. So I think it was something like $50,000, I think, to actually get the ETF up off the ground. And then, us running it about as bare bones as you possibly could run an ETF operation, which was only stocks. We didn't have any complex stuff in there. It was probably about $170K a year. And, back in the day, we charged 79 basis points, I believe. So, our break-even point was somewhere 25 million, something like that. So that was the math then. The math has probably changed a little bit. And as Justin mentioned, like our friend Wes Gray has a service now where he launches ETFs for people. And, those types of things used to be a lot more expensive, but he's driven that cost down to a lot closer, I think, to the 170K that we paid doing it on our own. But he does everything for you. So, it's a different landscape than it was. The exemptive relief is not a big deal anymore. So and also back then there was this whole active passive thing. You could have an active ETF or you could have a passive ETF and that still exists. But the difference was the idea was with a passive ETF, you had to run an index. So you had to go get an index provider. You could still have an active strategy, but you had to put it into an index. And so you would run an index, you would get an index provider who would provide the index, and then the fund would be run based on the index. If you were an active ETF, you didn't need the index. But both of them were, from a practical standpoint, like in terms of how the strategy was run, they were the exact same thing. You could run the same exact strategy as a passive or an active strategy, but back in the day, there was a lot of decisions to be made around that because there were pros and cons of both of those things. And now there really is not. Like some of the cons of the active thing are gone. But back in the day, that was an issue as well when we were starting it up.
So maybe a dumb question, but anytime somebody's starting up a business or thinking about this, like, how did you even know to ask that stuff? Like, how did you figure out all the layers of questions for this?
Yeah, well, some of it was research on our own, but a lot of it was US Bank actually was the firm we used behind the scenes to do, like, they were our custodian, they were our administrator, they were all that stuff. And so they were really good. Like, they had been through this a bunch of times with a bunch of people like us. And so, they were able to outline for us, here are the types of decisions you have to make. Here are the important things to do. But even with that, like, it was definitely a learning process for me. Like, when we get into trading later, like, the way an ETF trades versus the way you trade your clients, if you're running like SMAs, is very, very different. And much more, you can make more mistakes that way. Thankfully we didn't, but you can. So we'll talk about that later. But yeah, it was basically US Bank helping us and just learning as we went.
And on that point, our ETF sat inside like a trust. So US Bank had this trust that has an independent board of directors, but within that, you had multiple ETFs as part of the trust. I don't know if there was like maybe 10 or 15. At some point, the trust kind of gets maxed out in terms of the number of ETFs, or is it ETFs or our advisor? Yeah, the ETF sits inside the trust. So,
yes.
there was like that embedded network. And in terms of like knowing what questions to ask, the costs, active versus passive. Jack, I think we launched as a passive and then we converted to active, right? Once we knew we could do the create and redeems.
No, we actually launched.
So we did it
twice.
Okay.
We launched as active. We went to passive, and then we went back to active. Yes. So, I mean, I guess that this is a good time to probably provide the color around that. The idea was there's these things. Well, first of all, like, we mentioned the tax efficiency of ETFs before. The reason that exists is because of these things behind the scenes called creates and redeems. And what happens there is basically, if you have demand for your ETF, the market maker needs to have the shares to give to that demand. So what they can do is the shares can be created and given to that market maker. And so you give them something of value. What they give back to you is the actual holdings in your ETF, something of value as well. So it ends up being a tax-free transaction. But what happens is that allows the market maker to either create or destroy shares of ETF at any given time. And in exchange for that, flows back and forth the holdings. So obviously, if people are redeeming our ETF, we're going to have less holdings because we have less assets. So it works out as like this tax-free transaction. But anyway, so that's the way it works when money's flowing in or out. But what happens is the reason ETFs are tax efficient on the rebalancings, which is not when money's flowing in or out, but when you're actually trading stocks, is these things called custom creates and redeems. And what that is you can, as part of your rebalancing, you can kind of do a create and a redeem that wash each other out. But in terms of the securities that are flowing back to them out of the fund in that process, you can take your stuff you want to sell that has a gain. And by doing that, you're washing out the taxes basically. So there is no, if you had just sold it, you would have taxes, you would have a gains distribution at the end of the year. By using these custom create and redeems, you're able to avoid that. And so that gets back to the question of active and passive, because at the beginning, when we launched our ETF, most people believed that active ETFs could not do the custom creates and redeems, which meant they weren't allowed to, which basically meant that you would not be able to take advantage of that tax efficiency. So we launched not realizing that. But thankfully, before we ever had any gains distributions or everything, we did realize that, and we converted to passive so that we could do that. And then the rules were changed to allow active ETFs to do that. And so you go back. So there was a lot of stuff going on behind the scenes. Like I said, you can run the same exact strategy as a passive or active ETF. So it had nothing to do with the investment strategy, but it had everything to do with the rules. And so we had to make some adjustments on the fly, based on those rules.
Do you remember if it was that like, is the IRS controlling that piece on like the custom creates and redeems at that point? Where'd that ruling come from then? Do you remember?
My belief is it's SEC.
Just
based.
SEC.
I believe so. Again, I'm not an expert in that, so nobody should take that as
you can take that part out.
Definitive answer. I was learning on the fly as we go too, but there was definitely when we launched, there was debate. Like most of the authorized participants, who are the people you needed to do these custom creates and redeems, were of the belief that you could not do them if you were an active ETF. And so you need them to do it. If the rules say you can't do it, we couldn't do it. So we converted to be able to do it, was basically what we did.
Let's just assume that no one at the SEC was talking to the IRS when they came up with that rule. Because if they were, somebody at the IRS would have been like, wait a minute, buddy. But it exists.
Yeah, this stuff is all way above my head in terms of like, I was more on the logistics day to day. What can we do? What can we not do? How to do it? Like in terms of like how all the rule making was, that was definitely above my head.
Well, it's the aspect too of like, this was still a burgeoning or a younger industry when you guys were doing it. And anytime there's a younger industry, there's a little bit of that Wild West component. Because even if, did you say it was US Bank? Is that who you guys did it through?
Yes.
So like even for US banks, so they've been through it a bunch of times. It's not like they've been doing it for 50 years. Like you weren't launching a brand new mutual fund per se.
See, and the other thing that needed to happen out of the gate, we needed to secure seed capital. So I think, was it Deutsche Bank, Jack, that we went down to the city and we kind of pitched them on the ETF. And what they wanted to know is that, within the first 30 days, I think they put 2.5 million in, if I remember correctly. And then, so they seeded it and they created like the ETF on whatever day we launched it, December 10th, 2014 or something like that. And then over, a period of time, over the next month, we basically allocated client assets into it. And then they got their seed capital out. But that's another thing. Like if you don't bring your own assets, these seeding firms, I think it's gotten a lot tougher over the years to sort of find people that are willing to seed you if you don't have a clear plan to, bring assets almost immediately to get them out of there.
Yeah, I think it's worse now even. But yeah, basically the idea is if you want someone to give you they give you $2.5 million, to get the initial shares of the ETF trading. But obviously they don't want to own your ETF. They want out of there as soon. They can hedge their position so they don't like lose money in the market, but they still they want the money back. And so the idea is you have to give them some idea that we have some sort of plan that's at least going to get $2.5 million in this ETF pretty quickly so that they can be out of it. And whoever is going to be in is going to be in who actually wants to be in the ETF. So it was tough to convince them because they don't really get anything for that. You're not like paying them money to do that. A lot of times I think it ends up being like the firm that does it sometimes ends up being the market maker, the lead market maker on your ETF as well. But like they obviously being the lead market maker in like some small ETF like us is not, some lucrative thing. So it was very hard. Like it was surprisingly, and I think after we did ours, it got a lot harder because a lot of ETFs launched and, sometimes I think they probably did have issues with the seed capital. So it became more challenging.
Let's just talk about the investment side of it. Before we get into maybe some of the lessons that we think we learned along the way here. But, I think as we mentioned, was at the time coming off of, if you remember, so you had the financial crisis, you kind of rolling through 2010, 2011, 2013, value was still relatively underperforming. There might've been a bout in there in 2011 when maybe value had a good run at the end of the year, something like that. But, in late 2014, we were kind of looking at like that relative underperformance of value and thinking, wow, there's going to be, a big reversion here in traditional cheap value stocks, the type of stocks that some of our strategies tend to buy. And, it was about 6 years before that turn actually kind of happened. So we were very early on that call.
Yeah, and I think part of it is, if you just look at like our idea with Validity is we try to find these published strategies that have good long-term track records. And if you kind of break those down and group them by factor, just by the nature of like the way strategies have been run historically, there's way more value strategies than there are momentum or there are quality. I mean, they all have components of all that, but there's just more value strategies. So it wasn't like we said, like, we're going to go all in on small cap value. It's like the nature of our strategies were very small cap value based, especially relative to something like the S&P 500. I mean, we're equally weighting our positions. We're selecting from a 2,700 stock universe versus 500 market cap weighted stocks. So by definition, we were going to have massive exposure to size and we were going to have massive exposure to value. That was just the nature of it. And obviously we've talked about Cathie Wood launched at the same time. Like obviously you wanted to launch the innovation growth ETF at that time, not the small cap value ETF, which is, a random thing. I mean, we were trying to run something that we thought was going to work for a really, really long period of time. Unfortunately, the reality of launching ETFs is like someone sitting in, and you're not going to do this yourself, Matt, but someone sitting in your seat who's picking ETFs, they have to say, all right, this ETF came out. What can I use to evaluate it? And obviously you can look at the details, you can look at the investment strategy, but the nature of like the individual investor out there is the one component they're going to look at that they can see that's in front of them is the performance of the ETF, because that's the one thing that's there. Like it's great that you can say, all right, here's our strategy and here's all this stuff. They're like, what have you done in the first 6 months? What have you done in the first 3 months? What have you done in the first year? So if you happen to launch a strategy that is at a time where it's not working, you have a huge headwind against you. And that's something we learned through the process. Like that was a big issue for us. It's just the types of stocks we were buying, were not working at that time.
How did you assess, like, were there other small cap value funds of a similar ilk when you launched? How did you assess that?
There were, but not nearly as many, which is one of the things, like if we were doing it today, it would be even more challenging than it was because there are tons and tons of cheap small cap value funds now. like there were definitely small cap value funds. There was the Vanguard type stuff, the really low fee stuff.
Well, the
But
Russell
like in the
2000
active,
value.
yeah, I mean, Wes had his, quantitative value was out. MEB's shareholder yield is sort of a value fund as well. Like there was a bunch of stuff out there that were value funds, but there was way more white space then than there is now. I mean, now there's if you want to go find a small cap value fund, I mean, there's probably, I don't even know, hundreds. I don't know how many there are, but there's a lot. So it wasn't as crowded in 2014 as it is now.
And the other thing that I've seen, I don't know what the compliance regulations are. We always benchmarked, Jack, I think we showed, which was not really right. We showed the S&P 500. We never showed like the Russell 2000 value, right? We were always showing the S&P, right? On our
we tried to show what people would judge us
Right.
against, and most investors out there, like whether you like it or not, whether your detailed analysis shows it's the right benchmark or not, like your average investor out there does not want to see the Russell 2000 value or whatever, that index. They've never even heard of that. Like they want to see what have you done against the S&P. So we put that on our website. Like I think you have a lot of discretion around that as an ETF provider. Like a lot of ETF websites, you just won't even see a benchmark.
Yeah, you don't even see a benchmark.
They'll just put the returns of their fund out there, and then that's it, and they won't put any kind of benchmark. So I think you have a lot of discretion around that. But we tried to put the S&P because that was ultimately what people were judging us against, even if it wasn't what our portfolio looked like.
And by the way, at the time, you still did have that like massive trend towards passive investing. So it was like we were trying to swim upstream going against that. I don't think our fees were at 79 basis points. They weren't on the higher side, but they weren't like 10 basis points. Like maybe you could buy the S&P or any of those other indices, for such low costs. And it just, the S&P was just, if you think about that period from 2014 to when we shut it down in 2020, it was like the S&P was like, I think Wes has said this, it's like Sharpe ratio of like whatever, 0.8 or 0.9, like best performing strategy, because it was just such a mega cap dominated, large cap growth type market that was being, that was rewarding investors.
And the other thing on the fees issue is, that's one of the reasons I was talking about it'd be much harder today. I think when we launched, like using Wes's quantitative value as an example, he was in the vicinity of where we were on fees, 70 something basis points, probably something like that back in 2014. I think he's at 30 now. So, it just kind of shows you how much tougher it's gotten. Like, and Wes has achieved scale, so he can do that. But like, if you were coming out of the gate right now with a small cap value ETF and you could charge 30 basis points instead of charging 79, I mean, your break even is like $50+ million or something like that. So it would be very hard. Like Matt, if you're considering starting the Matt Ziegler small cap value ETF, I would probably advise against it now.
I always
because it may not work out for you.
I'll call Kathy Wood. We can launch a fund at the same time, see what happens.
Well, I don't know if we mentioned this, but so the way that we constructed it is we took, at least out of the gate, we kind of changed towards the end a little bit, but we had 10 different strategies, each selecting 10 stocks. And so it was, a sleeve-based approach. I think it ended up being like 7 value strategies and 3 like growth and momentum models. So to Jack's point earlier, more of our models were value at the time. And so that's why it was 70-30. Plus, we kind of thought, there's going to be this turn around in sort of our type of style, value investing. But it was 100 stocks. And did we, remind me on the rebalancing, we were rebalancing 4 times a year, quarterly, or were we doing the...
No, we always did monthly.
We did monthly. Oh, we still did monthly.
Yeah, we always did monthly.
So that was kind of one of the things that was like one of the things that I do think investors sort of liked was, we could still have this like more active rebalancing approach, and which we're kind of known for doing monthly rebalancing for people that have touched Validity in some way, shape, or form. And so they sort of like that, but the tax efficiency of being able to do that was also nice because it was in the ETF wrapper.
Yeah, and I think an interesting point on the 100 stocks is, so we typically, for like our clients with what we run in SMAs, we'll run maybe 30 to 50, 60 stocks at the most usually. And we ran 100 in the ETF. And I think one of the big reasons for that was, when you run focused quantitative factor strategies, like hand holding and behavior become a big thing. Like you're going to look a lot different than the market. You got to be able to explain to people, why are we different than the market? You've got to get them to stick through the rough periods. When you go to an ETF, you can't do that anymore. Basically people could just go to their brokerage account and buy and sell all day. They can go crazy. And so we wanted to try to, understanding how people behave, we wanted to try to limit the tracking error to some degree. And it was still very high tracking error, but limit it to some degree. So we came out with more stocks in the ETF to try to some degree protect people from themselves and try to make the ride a little bit smoother so that we wouldn't have, too much buying and selling based on behavior, which I'm sure we did anyway, but that was the general idea behind it.
The other thing that we looked at, now it was never a problem for us, but we were also thinking about like the implied liquidity of the ETF. So how much assets could that 100 stock strategy hold on the high end? Because that is something, ETF providers, you can't really close down an ETF, right? Like a mutual fund, you can close it. A very successful ETF, I don't think at least, you can close that. So I think we wanted to make it so it was if we had kept it around, if the track record was a good one, we could say, okay, we launched with 100 stocks. It's always been 100 stocks, whether it got to 500 million, a billion, or, more than that, that portfolio could handle that type of liquidity. And we'll kind of talk about that in one of the lessons here. I think we want to talk about some of the lessons we learned along the way, but I do think that was our thought sort of coming out of the gate, that we wanted to make it so it could be scalable and it wouldn't be like we'd have to double the size of the portfolio if we got to like $1 billion or something like that,
It's always good to plan for that, just in case you got to that $1 billion.
Yeah, we have our plans for billions of assets coming into the ETF, which I think we peaked out just at around 30 million. Is that right?
Yeah. So we were,
I think it was something like that. So we didn't, the multi-billions never came, Matt, but
not
just in case, we were ready. And to Justin's point, like you can't, the nature of the ETFs is like, if money comes in, money goes into the stocks. So like you have to some degree plan for, like, if you did get significant inflows, like you want to try to run a strategy you can consistently run throughout the whole process. And, if you have, 20 small cap stocks, that there's a certain point where that's going to cap out. And so we were thinking about that as well, I think.
We look at those capacity constraints as allocators all the time and think about managers. And if like it's an active manager, how many assets can they handle before that edge gets arbed out or they lose that or whatever else. So it's a very real consideration. It makes sense you would spend so much time on it in the launch phase of a fund.
The other thing that was tough with ETF, I think it's changed a little bit, or maybe this was always there. It's just we could never afford it. We never had really transparency into who was buying the fund. So, if one day we got like a decent size order, I think Broadridge might report out, like if an advisor at, Merrill Lynch or an independent RIA, I think they have some level of like transparency into that, but that's a very expensive piece of like sales data. We never opted to pay for that. So as for me sitting like on trying to, sell the thing, I never really had good insight into who was buying or selling. Because I do think, as someone that is, if you're launching an ETF and you want to know who your investors are, because if you can reach out to them or develop a relationship with them, that is good. There's potential for more assets. They might stick with the ETF longer. But we never really knew who the buyers were on our side.
Yeah. And those create and redeems become like the thing you're seeing, like in terms of like, oh, are we doing well or not? Like you'll get an email that when those creates happen, which means more money's flowed into the fund. What did they call it, the basket or whatever, but it was like 1.25 million per one of these creation units. And so once you got enough flows in that like exceeded 1.25 million, they'd have to create another one over and over again. And so that was like the way we knew like we were getting assets, is we would get these creates.
Which is really funny to think about, because like you're launching a mutual fund, every time somebody drops a ticket, to use the old language, every time somebody makes an order, there's a tag on who's buying or selling my fund. Where's the redemption or the order coming from? With an ETF, it's happening at the exchange level. You don't have that. It just makes it, like you said, that data is hard enough if you're a huge provider. I can't imagine having a $25 million fund and just being like, well, call us if you bought some.
Yeah. And with the mutual funds too, because they're getting like the flows like end of day, basically, what they're effectively getting is they just get cash when people start buying their funds, and they can kind of figure out what to do with it. Like with the ETF, it's like a thing that happens in real time. So money's flowing into your fund at like 11:30 in the morning. A create's made, you're getting holdings back. Like you're getting the exact holdings of the fund. Like it's kind of this ongoing process. It's very different than, but you also don't have the discretion around like, how do I want to deploy this money that's coming in? Like it was just coming in and it was going into the assets in the fund, the existing holdings of the fund.
Yeah. Which is always a really fascinating point about passive, because it's that discretion on the money comes in, somebody wants to buy more of the fund, or, you know, everybody's 401k allocations get posted at the same time. And now it's just like, even though you're a value strategy, that part doesn't care about what's more valuable inside of the holdings themselves, right?
You're definitely right about that, though. I mean, you get like, as a manager, sometimes you want to have, like, if money's flowing in, you want to have some discretion as to where do I deploy that? Like, what do I think is more attractive? And at least the way we ran the ETF and the way they were run back then, like, that wasn't the idea. The idea was basically just match the holdings, match the weights. You end up with the same exact weights after the, creation order as you did before. Like, you end up with the same exact fund. You're not sitting there saying, oh, we find, but also as a quant, that kind of works out for us too, because we're not like sitting there analyzing all the holdings and saying like, oh, we find this holding more attractive. We're really trying to create equally weighted baskets of large numbers of stocks. So for us, it worked out fairly well, but I could see, like, as an active manager or something, you have this position that's down or up or whatever it is that you feel more strongly about, like you might want to allocate more towards that.
So let's get into some of the lessons here. And this first one, you kind of hit on it already, Jack, but it's important, especially for small ETF issuers like we were, which is, and we say this all the time. I mean, anybody listening to this podcast knows that Matt, Jack, and I, strongly don't believe in waiting or following or, putting much emphasis on short-term performance. And how you define that is, maybe that could be part of this discussion. But the point is if you launch an ETF and, you're saddled with bad performance out of the gate, maybe you get unlucky, maybe the strategy's kind of fallen out of favor, maybe the strategy doesn't work anymore. But there's different things, obviously, that can influence the performance of these investment strategies. But it is important in the sense that investors weigh that short-term performance. It's hard if you launch a fund and you're putting underperformance in front of people and that's all they see. It's hard to convince them. You can talk about your process and you can talk about your strategies and the importance of fundamentals and the importance of long-term investing, and all that stuff matters tremendously. But at the end of the day, people are still going to look at that performance, even if they shouldn't. And so I don't know, you can't really game that or time it. Like we talked about, we, thought it was a good time to launch a value strategy, and it just, for us and our type of value investing, it just wasn't. So that performance mattered a lot to us.
Yeah, I think we probably underestimated how important that was. Like you said, it shouldn't matter, but it's all there is. Like when you launch your ETF, like, I mean, you obviously have your description and your strategy, but all there is the performance. And so anytime we would talk to anybody about the fund, they'd be like, "What's your performance been?" Like, "Well, it's only been out 3 months. Well, I don't care. What's your performance been?" And so I think we probably underestimated that as a variable. And that doesn't mean, it's not judging whether it's right or wrong. I would just say, like, if I was launching an ETF today, and it's particularly if it was an active ETF, and the more active it's going to be, I would understand that's a variable. Like the success of my ETF is going to be a function of a bunch of variables. One of those variables I have absolutely no control over. And you just have to understand, like, that may work heavily in your favor, as it did with ARK, or it may work against you like it did with us. But it's just, that is definitely a variable that's going to determine your success. Is do I come out of the gate with good performance? It's just the reality of doing it.
Good performance and how you can tell the story, which is extra hard when you're semi-detached from some of your investor base. But it's like you opened a restaurant and then the pandemic happened. It's that stuff that, like, it's out of your control. So you have to have a way to deal with it, or else you're just totally at the mercy of what it throws at your feet.
There's a very important detail that we kind of failed to mention, which I want to make sure this gets in here. So when we launched our ETF in 2014, we actually had a pretty sizable investment mandate in Canada, where we ran mutual funds for the 6th largest bank in Canada. So at the peak, which wasn't at this exact time, but we were sub-advising on almost $1 billion in assets in Canadian mutual funds in Canada, and we were getting sub-advisory fees. So that was a very big piece of business, as you can imagine. It was creating a lot of excess cash flow. So when we launched the ETF, we knew we had runway. Now, eventually that sub-advisory mandate went away too, which is another, maybe that'll be the other podcast for next week or something like that. But in 2014, 2015, we had, the point is we had the cash flow coming in from other areas of the business to fund this ETF. And so to the short-term performance thing, you know, especially for small ETF providers, and I believe Wes, well, I know that a lot of these white labeling sites that smaller issuers partner with, you know, they want to see at least, a couple years of funding available, because if you do get really unlucky and launch an ETF where it's just a really bad time for your type of investment strategy, you know, they don't want these ETFs shutting down after 1 year. And for us, we didn't. It wasn't like, oh, we got unlucky in 2014, 2015, 2016, let's shut it down. I mean, we ran it at, you know, a loss for many years trying to make it through to the other side. But then we'll talk about what happened during COVID, and then we kind of shut it down. But I'm just mentioning that sub-advisory sort of mandate as important, because that money helped kind of fund the ETF business and give us, you know, the runway we thought we needed to make it.
Yeah, and we actually took the money for, I think it was a couple of years worth of costs, and we actually put it elsewhere when we launched the ETF, just to make sure. It wasn't being treated as part of our business. We just had it kind of sitting in a different account, and we were like, we knew going in, like you had to have at least 3 years of runway, you know. And also at that point, like I believe 3 years is when you can get a Morningstar rating. I think you need to have 3 years of performance to get a Morningstar rating. So we kind of looked at it and said, all right, we have to at least make it to that. And so we ended up making almost 6. But that was, it's definitely, I mean, it's a tough business. And I mean, these days it's a much tougher business. I mean, it was worth doing because it was a great experience. And ultimately, you know, that's when you start any kind of business, I mean, that's the reality of it. Like there would have been significant upside for us probably with that thing if it had worked out. But you also understand there's the downside. And as long as that downside was protected, you know, we put the money away to run it and stuff, it's okay. But yeah, it was, I guess, an interesting experience to say the least.
You live to tell the tale, and it's a fascinating experience. I get to learn from you on the other side. You know, we see stuff like this. We see products and ideas all the time as allocators, but sometimes it's just like I don't know how to build the microphone that's in front of me that's recording this thing, but somebody does. And it's amazing that it's here and that it works. But how many things have to fail and go wrong till you have something that works? So talking to people who have made stuff that's out there, that's a really cool and useful thing.
So the other interesting, I remember we went down, I forget what major investment bank it was. And we'll talk about sort of some of the hurdles with smaller issuers in a minute. But I remember we went down to one of the major investment banks trying to get up on their platform and get approved. And I actually remember, Matt, Merrill Lynch, they may now, but at the time, this is back when we first launched, they wouldn't allow active ETFs to be on their platform. They only allowed passive. It wasn't Merrill Lynch we were talking to, but it was a comparable type firm. And I remember being in the conference room with a couple of their analysts and like gatekeepers for the ETFs. And they were like, what are your plans for launching other ETFs? And we sort of, because we were funding this ourselves and bankrolling it, and we just wanted to have this one be a success, like our answer was like, this is it, kind of like, unless this becomes a really big success, like we don't have any immediate plans to launch any other ETFs. And we would kind of defend that answer and say, you know, we're putting all of our resources behind this one. We think this is like the best strategy. However, we responded to that. We were kind of, you know, trying to dance around the question. But again, in retrospect, when Jack and I sort of think back, you know, you can see why sometimes firms launch a handful of ETFs at the time. So if we would have launched a value strategy, a growth strategy, maybe a momentum strategy, maybe we could have gone large cap quality or something. I mean, you can slice and dice our models in 20 million different ways, but you know, one of them probably would have been maybe a success. Maybe, you don't know for sure. Maybe they all would have failed, but you know, you could see how, you know, if you throw a lot of darts, one of them is going to hit. And that's what a lot of these ETF providers do. They actually launch a bunch of them, and then, you know, half of them go under. I'm talking about larger firms now, you know, the ones that don't succeed, they just sunset them and then they launch, you know, a whole set of new ones. So that was another interesting lesson. And I always felt like we answered that question correctly at the time, but in thinking about it and reflecting on it, you know, no, I think the answer is probably we should have been launching other ones, because maybe one of those ones would have been the very successful one while the others sort of floundered. I don't know what you think about that, Jack, but.
Yeah, no, I thought we probably should have, in looking back, we probably should have done 2. We probably should have done one on the deep value side and maybe one on the momentum side or something like that. But I mean, we didn't really want to do what the big providers do. And you see this all the time. It doesn't get like a ton of news and stuff, but the big providers shut ETFs down all the time. And what they'll do is throw it out there. Like they'll give it a certain amount of time. If it doesn't work, it just goes away. We didn't want to do that. I mean, we wanted to, like, either Meb Faber always talks about, I don't believe Meb has ever shut down a fund, like of all his ETFs. And that's what we obviously didn't achieve that, but we shut down the one we ever launched. But like, we wanted to do that. We wanted to like do something that we thought was a really good, sensible long-term strategy. We could have done that on the momentum side and put 2 out, but obviously it's double the cost and double the risk and, all that stuff as well. So, I don't know that would have been the smart move, I think, is, if you want to just hedge yourself and say, let's have 2 different types of things, one of them is going to work, but I don't know if that was right for us or not, but you could definitely make an argument. Maybe it was.
You're launching a product. Like, this is the part of the thing where we're not talking about coming up with an investment strategy or implementing one thing for one person. We're talking about issuing a product for multiple people to use. And now all of a sudden the conversation is not about, is value a good strategy or is momentum a good strategy? It's putting 2 products out on the market to see what do people actually want, and then what actually happens in the world that maybe helps drive the rest of that behavior.
Yeah. And, going back to Justin's point before, and this is sort of one of our lessons with the idea of how many barriers there are for like a small firm. Matt, you can probably understand that from your side, because if you were on the other side of us and you were evaluating our ETF, you're going to look at things like, are these guys still going to be around? What are the assets in this fund? How much is the daily trading volume? You're going to probably look at a lot of those things. And that's what you run into as a small ETF is like, you need the size to get people to look at the fund, but you can't get the size unless they look at the fund. And so it becomes this, so maybe, I don't know, what do you like think about? I mean, you probably use mostly larger ETFs, but how do you think about that idea of like, if you're evaluating an ETF, like, is this big enough that we can invest in it?
Mostly larger ETFs, especially now, that's definitely part of the consideration. And years and years ago at Merrill when I was at Merrill and some of the newer ETFs were coming out, probably around this time, and we'll ignore the whole platforming conversation. Wes Gray has some amazing posts on paying for the rails and all the other stuff, paying for the shelf space and all the other things for that. And those are well worth reading, because I had to read those back in the day. And Wes was so kind as to talk me through like, hey, why can't I do some of this stuff here? But these are considerations, because if you're an allocator, things you don't want to buy a fund and then have it go out of business or fold and return you shares or return you cash in 6 months or maybe even like a year, especially if it's an idea that you want to implement. The record of funds that have gone away or blown up because they've been too thinly traded, too small, too whatever, that's egg on your face as an allocator. So it's a really fine line between saying, here's a good idea that I really like and I want to get some weight behind because I want it to be around, and how do I make sure this doesn't look like a foolish decision on behalf of clients? Another one that comes to mind is earlier on in some of like the ESG stuff. So this is more than 10 years ago at this point. Some clients with ESG mandates and stuff we were doing, we had a lot of problems with the open-end funds and some of the things that were doing this business. There were a couple of indices that were out there that hadn't been brought out with ETF products related to them yet. So we were doing some manual implementation based on these indices for various clients. And I remember like poking around the SEC filings to go like, oh, there's 1 or 2 companies who have bought rights to this index to make a product, and being like, when you're seeding this thing, can you please call us so I can call my ETF desk and figure out a way if we can do this for clients, because trading these indices is driving us friggin' crazy. And so it's a weird way that like both sides of the ecosystem solve this problem with products. And then also fascinating that products sometimes just aren't the answer and these things get shelved.
Yeah, and if I was sitting like in your seat, I would do the same thing every advisor does. Like I would be looking at it like, do I want to put it, this is a small provider. Is this thing going to be around? And also what's interesting, like what I alluded to before, is the big providers probably shut ETFs down at the same rate that the small providers shut ETFs down. So, to some extent, the small providers get don't get a great deal with this. But even with that, I would think like if you put clients in, X BlackRock ETF or whatever, if that ends up shutting down, you're probably looking better than you were if, you put it in random company clients never heard of ETF and that shuts down. At least they understood you had the brand name of BlackRock behind it, even if it shuts down. So yeah, it to some degree is unfair, but it's what I would do too. Like if I was sitting on that side, like, and it's what I do now, by the way, like we use some outside ETFs, like, and if we're going to use some ETF for like a random area and there's not tons of assets, like I'm going to look at that kind of stuff and say, like, is this thing going to be around if we're going to start using it?
an interesting time to be talking about this, given that yesterday the SEC approved the Bitcoin spot Bitcoin ETFs. I was actually looking at, kind of going off topic here for a minute, but I was actually looking at, we custody and trade all of our client accounts at Goldman Sachs, which was formerly Folio FN. And I was just seeing if any of those ETFs, I wouldn't imagine, some of them are like already out and I think trading. And I was like wondering like when Folio or Goldman now, is going to allow or bring those ETFs into their trading list, which will be interesting to see what the timing is. But it's the same with startup ETFs. It takes time to get distribution and get on these different platforms and stuff like that. So anyways,
there were we don't want to get too far off topic here, but there's 6 or 7 that launched today,
I think,
like that.
Yeah, I just saw the Van Eck one. I was surprised they launched so quickly. I didn't know they had them like the SEC approved it and now they're trading. And I think, I don't know if somebody posted, I thought what Balchunas on Twitter was like, I don't know what he said in terms of assets already or volume or something like that, but it's pretty crazy.
I'll have to look when we get off. Did GBTC convert today too, or no? Is that not done yet?
I do not know.
Okay.
Right,
we'll look at it when we get off.
Yeah. So, so what sort of the nail in the coffin for us, and this is I think it's a good lesson, because in retrospect, probably Jack and I might have a little bit different opinion on this. It probably was, in some ways, it was the right decision at the time. We didn't know all the facts. We didn't know how things were going to play out, but it might have been the wrong decision. So we got to 30 million at the peak, and then COVID came. Obviously, we got cut in half. So between losses and redemptions, that 30 million went to 15 million. Now, at that time, so this is in the spring of 2020, if people remember, that was like a waterfall decline for the S&P 500, 35% in about 30 trading days. And now we didn't know how quickly the market was going to recover and what the Fed did and blah, 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 and the crazy rip that value was going to have in later on that year. And but we were, at the time, we were unprofitable on the ETF. We had lost the sub-advisory mandates a few years before that. So that was not great. And then we just sort of said, we have this track record going back to 2014, especially when compared to the S&P, it was just really bad. And so we said, as a business, we think we have to shutter this thing. Fortunately for us, a lot of the clients that were our clients that were invested in the ETF, they believed enough in our investing system and strategies, and they valued the relationship that they were, we saved a lot of them. So a lot of them just went back into the SMA. But I think, the big, and in retrospect, our stuff, especially during when value bounced back, sort of the really cheap, and we were rebalancing into that. So if you think about and Matt, you brought this up, I think a few times with kind of your Super Mario Punch thing a little bit, is, if you're taking the opportunity to, and our system naturally was doing that, the investment process was naturally selling stuff and then buying even cheaper stuff because stuff was down. So, I think we bought Signet Jewelers or something, which, who thought during the low of COVID that people were going to be, but Signet ended up being a crazy winner. That's just one example. But the point is that, we kind of were going through this volatile time, and this is what investors do a lot. And they kind of assume the worst and maybe I don't know if our decision was irrational. Jack, you've kind of, when we've talked, you've tended to argue that, given what we knew at the time, it was actually a rational decision. And so, but, it just kind of goes to show that, making decisions in uncertain times can sometimes really be, not be the right decision, I guess, what I'm trying to say.
Yeah, you kind of have to separate out the investing decision from the business decision. So we made the right investing decision then, which is all these people that were in the ETF ended up going in more focused small cap value funds that we ran on the SMA side. So we didn't say small cap value is a disaster, we got to get out of small cap value. It was the business decision of, this thing is losing money. It's been out 6 years now. We gave it a really long runway. And also the landscape of small cap value ETFs is very different than when we launched. There are a ton of them now. And a lot of them have very, very low fees. And so ultimately as a business, even if we have the huge run that we expect to have, and that huge run happened, is this still, is this going to be a viable entity when there's so much competition. Eric Balchunas calls it the terror dome, I think, or something like that, the ETF space. It's a brutal space, and the people that have scale can keep cutting and cutting fees. It's a really tough thing. And so it was like, is this the right decision for the business? And I think it probably was in retrospect. It's hard to say. And the other thing was, going back to your point about taxes, like we had clients who invested in this for the tax efficiency of the ETF. And the reason I think that was a really good time to shut it down is
That's right.
the ETF at that point had losses. And so if you're going to do it, like do it in the most tax efficient way you can for your clients. And so if the ETF has losses and we shut it down, the clients can realize those losses. They can stay invested in small cap value, and they can move forward. So it was a tough decision, but I think the combination of those two things, it's easy to look at the fact that small cap value performed really, really well out of there and say, well, we would have attracted tons of assets and it would have been a huge fund and stuff. But we also have to keep in mind the landscape that there were a lot of other small cap value ETFs that also had really good performance and did really well off of that. And so would we have attracted, the assets? That's a tough question. I don't know the answer to it, but I think we made the right decision at the time, but it was obviously a tough one.
I always think about how we talk to clients, like you shouldn't think about buying a stock without thinking about selling a stock, or buying a fund without thinking about selling a fund. Shouldn't think about starting a business without exiting a business. And that doesn't mean selling it at some glorious multiple to somebody else or going public or whatever. Sometimes it just means sunsetting the business. And you guys realized the right point in time where it was like, yep, time to sell this thing. It's time to end this thing and put it to bed. And that's never friggin' easy, but you did it in a graceful way. I commend you for it.
I'm sure emotion played a part in this. It had to.
Absolutely.
If you think about what all of us were thinking during COVID, like this was right in the heart of COVID. So like the economy was shut down. Everybody's working from home. You're like, what is the future going to look like?
Austin was busy trading GameStop.
Right. Exactly. Like, is the market going down another 30%? I mean, there was all kinds of craziness at that time. So as much as we're like these emotion-free quant guys or whatever, like that affects everybody. Like, and I'm sure that played to some degree a role in the decision. Like, what if this gets a lot worse than it is now? So I think that probably was a small part of it as well. No one can avoid that no matter how much you train yourself. But yeah, it was, I've always learned with these decisions. I mean, you make the decision you think is right at the time. You try to learn from it for future decisions. Like that's all you can do. There's no point in going back and like revisiting it. And other than what you can learn from it, there's no reason to go back and doubt yourself and say it was the right or the wrong decision. And even going back right now, I'm not really sure. I mean, I can't really say for sure if it was the right decision or the wrong one.
But you did it without hurting any investors. Like the people you set out to take care of, you still took care of, even though it wasn't the most desirable outcome. And that's noble. That deserves recognition.
What's also cool about ETFs is like people will kind of have this thing like, well, what happens if the ETF shut down? It's obviously not the ideal thing, but the process is actually pretty straightforward and it works well for the investors. It's not like the ETF shuts down, so my capital is at risk or whatever. Like the ETF just, you have a choice.
Unless
to
you're
sell.
one of those Russian ETFs or something. But
yeah, exactly.
Yeah.
Like you announce it in advance that it's going to happen. People have the opportunity to sell the ETF if they want. And as long as they use, and we probably should have covered this in here, like as long as they use limit orders and they're smart about the way they sell it, they can sell it at very attractive prices relative to the asset value of the ETF, or they just wait until the end and then they just get their money back. I mean, that's the way it works. So it might be an inconvenience or something like that, but it's not like, if you ever do invest in an ETF that shuts down, it's not like your capital's at risk or anything. I mean, your capital is protected. We never had anybody's capital. The capital was off at US Bank at a custodian. So it's maybe an annoying process, but it is a process that like investors are protected throughout the whole thing.
orderly when done right, which is a noble thing.
Yep. So that's sort of the story in a nutshell. Hopefully people found that valuable. Let's just kind of wrap it up with, just talk about like the outlook for ETFs going forward. I mean, it seems like more and more established mutual fund companies are getting in the ETF business. That ship's already sailed. You have some pretty innovative stuff happening. I'm thinking like Corey Hofstein's like Resolve's return stacking and like what he's doing there. And then you have, Wes's white labeling business, and he has, I don't know how many funds now on that platform, and a lot of, conversions actually happening where mutual funds and or family offices are starting to convert those assets into ETFs for the tax efficiency benefit. But I don't know. One of the things that also has my eyes have opened a little bit, just because we kind of are involved in this business. And I do think, Matt, I'm interested in your perspective here. Like, certainly ETFs are very tax efficient. and they're really great for investors in a lot of different ways. We've talked about many of them, but I do think that some advisors, maybe not you, but some advisors and some investors still like to see the individual stocks in their portfolio. And so, part of me sees a world where like ETFs are just going to dominate. But then the other part of me is, you have like direct indexing, partial shares. I think SMAs are like a huge business, and advisors, I think, tend to like to somehow sort of be able to show individual stocks. And a lot of investors like to see individual stocks, and they like to see that there's some activity happening at the individual stock level because, they like looking at those stocks. They like maybe talking about those positions with the advisor. It might make on the surface it look like there's a little bit more work being done because you're just not holding these shares of ETFs and not seeing any activity. You're actually seeing some movement in the account when they're traded and all that kind of stuff. So I don't know. That's kind of just, what are you guys, just any thoughts on all of that?
I think it's direct indexing here to stay. ETFs are here to stay. SMAs to some degree are definitely here to stay. The mutual fund, I think in this entire conversation is the most problematic area, that the mutual funds are just going to go away. 401ks and a bunch of other things still make them a desirable vehicle to exist. Fractional share ownership could change that in the coming years as it becomes more and more widespread. But like as advisors, we're going to look at the existence and the ability to do direct indexing for like especially a less active strategy right now means the family office is less likely to launch an ETF than maybe they were 10 or 15 years ago as like an option you'd want to go all the way down. However, knowing that these options exist means people are going to find novel use cases for each. So I'm hugely optimistic on just the amount of power this gives both advisors and allocators and end clients for how they put these things into practice. Really, really cool. This is the democratization of investing stuff, and it is real.
Yeah, I think the outlook for ETFs is like both phenomenal and not good at the same time. So it's phenomenal from the perspective of the investor, the end investor. Like if you think about like when we launched, like your small cap value ETFs were something like 70 some odd, these focused small cap value ETFs were like something like 70 odd basis points. You can now get them for 30. Like you can't, and S&P funds have come down a lot. I mean, they're basically zero at this point. So like from the perspective of an investor, and also there's so much more choice out there now in terms of different strategies. So from the perspective of an investor, it's great. Now, if we were going to try to launch another small cap value ETF, it's not good. In that type of space, there's just so many players now. I mean, you'd have to have a really compelling reason you think you could be different to compete there. Fees are very low. One of the interesting things, two things on that. One of the interesting things you're seeing now, and our friend Wes Gray is doing a lot of this, is one place that does make sense is if you've got like a small cap value strategy you run for your SMA clients and you've got a lot of assets into it, you can convert those SMA assets now into an ETF. And so that's one place where I'm not necessarily worried about, I'm going to go out there and raise billions of dollars from outside investors. I'm basically, the benefit I want, I'm getting for sure because I'm able to convert my existing assets. And then if the ETF grows, that's great. That's an interesting use case. And then the other case I think is been good is like what we've seen like the guys at Simplify do, which is if you actually can find something that nobody else is doing. And Simplify, if you look at their ETFs, I mean, they found a lot of areas that just absolutely nobody is doing. And they were able to go there and raise a lot of assets. So if you had something like that, I think it would be good to launch an ETF. But if you're launching plain vanilla small cap value ETF, or even if you think you've got a better small cap value strategy than the next guy, like unless you're converting like your own clients or stuff, it's a tough place to operate right now because the fees are so low, the break evens are really high. You've got tons and tons of competitors out there. It would be a tough thing. But I think from the perspective of investors, it's all really great.
Matt, no song references? I made it all the way through. Come on.
I'm not going to give you a music reference. I'm going to give you I'm going to give you a culture reference though here. Have you guys ever seen the Swedish Museum of Failure? Are you familiar with this?
No.
I think every business needs to have their own Museum of Failure. But if you need to be consoled about this mishap that was the Validia ETF, I have a couple of the classics for you. So big companies who tried stuff that didn't work out. And that's all this thing is. It's a touring exhibit. I've never seen it live. I would love to. Have you ever heard of IKEA's airline, IKEA AIR from the 80s?
No, I have not. Wow.
IKEA had a line of inflatable furniture, which unfortunately struggled to stay inflated, but was apparently easier to assemble than that IKEA desk. We had Rejuvenique, which was a mask that would tone your face with a series of electronic shocks. So, great gift, for yourself, maybe for the spouse. One of the reviews stated it felt like 1,000 ants are biting my face. Does it help you sell? And possibly my favorite, pre-Google Glass, as a person who wears glasses can appreciate, the Nike Magnetos. Do you remember this fine sunglass with no armband? I'm going to let you guys guess.
It did not.
How did the glasses with no armbands stay on your face? Hint, Nike Magnetos.
Yeah, some sort of magnet, obviously, but I can't even think how it would work.
Yeah, all you had to do was glue magnets to your face.
Oh, no. Now I know how it would work.
So the Museum of Failure, it's an important reminder. We got to try again to come up with these ideas and see what sticks. The market will determine. There are objectively bad ideas too. But
I just hope our ETF didn't feel like 1,000 ants biting your face, Matt.
So if it didn't get that review, you did better than Rejuvenique. And that's the message here.
Good stuff. Good stuff. That's a good way to sort of end this. So thank you guys for watching. We'll see you next time. Hi guys, this is Justin again.
Thanks so much for tuning into this episode.
You can follow Jack on Twitter at @PracticalQuant.
You can follow me on Twitter at JJCarbino and follow Matt on Twitter at CultishCreative.
If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment.
Also, if you have any ideas for topics you'd like us to cover in the future, please email us at excessreturnspod@gmail.com. We would like this to be a listener-driven podcast and would appreciate any suggestions. Thank you.